In Chapter 7, we look at profit and loss. Now, people frequently describe market economies, capitalism, as profit-driven systems. And there's a sense, important sense, of course, in which that's true. But one point I want to make off the top is that they are, or at least should be anyway, profit and loss systems. And in this chapter, in Chapter 7, we'll look at the concepts of profit and loss and try to understand what economists mean by them. And Chapter 7 also looks at the role of the entrepreneur and entrepreneurship as a key element of how market economies work. What I want to do in the two video lectures for this chapter is first, in this one, talk a little bit about profit in general, profit and loss in general, and the role it plays in market economies. In the second video for this chapter, we'll talk specifically about speculation, and you should make sure you read the appendix to Chapter 7 that deals with speculation, because I will cover that, and we'll talk about that in the second video for this chapter. And so in the first video, this video, I want to talk generally about what we mean by profit and loss. Now, the book goes through this whole process of how we calculate profits. One of the things I want to emphasize there is this idea that profit is a residual, right? All the other things that we think about when we think about what the sort of payments to people that are part of a market economy. For example, the wages we get, those are a contract, right? We have an agreement, either explicit or implicit. I have a contract with Ball State. People have contracts with McDonald's and so on. So wage is a determined set number. Now, obviously, if you're on commission, it'll vary from month to month, but you know the rules. You know it's contractually agreed upon. Same thing with rent, right? The cost of renting a building or renting capital or other kinds of machinery, right? That's a contract, right? You know exactly what it's going to cost. Same thing with interest on a loan. If you have a loan to support your business, you know exactly what you have to pay back on that loan every month. That's all contractual, right? And so the people who sell their labor services, workers, the people who sell or rent capital, the people who lend money know that that's an assured income. Wages are the payment to labor, rent to landlords, interest to those who lend financial capital. Profit, however, is not contractual. Profit is a residual. It's what's left over after we bring in all our revenues and pay all our costs. And the key here is we just simply don't know ahead of time what our revenues will be. You can think back to the discussion in Chapter 6 of the dropouts and their CD to see this point. So when we think about profits involve uncertainty because we just don't know for sure what exactly those revenues will be, and we can't predict. It's not contractual in the same way that those other things are. What we mean by losses, of course, are negative profits, right? In general speaking, profits are when our revenues, our income, is greater than our costs, and losses are when our costs are greater than our revenue. I'm not going to walk through the calculations that the book does. You can look at that yourself. In particular, you should pay attention to the difference between accounting profit and economic profit. The key there is that economic profit takes into account opportunity cost. It takes into account the alternative uses of resources, right? So when we think about economic profit, the question really is, did we make the right decision in doing this thing as compared to the other, as opposed to how well did we do just doing this thing? Just how well did we do doing this thing? That's what accountants calculate profit. But when economists calculate profit, we also include in implicit costs or the opportunity costs. We have to subtract from your profits what you could have made in the next best use of your resources. So again, and I want to emphasize, it's not that one of those is the right way and the wrong way. They're just two different ways of calculating profit, asking really two different questions. So again, that you can all look at in the book. The book also has a good discussion of the entrepreneur, as does the supplementary video. I'm not going to add much to that, other than to say one way of thinking about the entrepreneur is a residual claimant. If profit is a residual, that is what's left over, the person or the entity that gets to claim the profit is the entrepreneur. That's what entrepreneurs do. They are the ones who gain the profits or are responsible for the losses from the activity, from the economic activity that they engage in. And what entrepreneurs do is try to organize and reorganize economic resources in attempts to create value. And if they're successful, they profit. If they're not, they lose. And so again, you can look at the book for more of that. What I want to talk about, though, is the sort of more general social role that profits play. And, people complain all the time that profits are bad, profits are evil, and so on. And so let's focus for the moment on what we might think of as a sort of genuine market, right? Where people buying and selling goods, there's no price controls, there's no monopolies, there's no government's not playing a role, right? You can just think about, sort of farmer's market or whatever it might be as a simple version. But even, right, to a large extent, most industries that we think of are largely fit this description. Okay, what are profits? What profits are a reflection of the creation of value. When we think about what it is that firms do, right? What firms do is try to figure out, we saw this with the dropouts, right? How do we create value, right? If they're seeking after profit, they have to ask themselves, okay, we are going to expend certain resources to make a product. We think we can sell that product for a certain price, and we think we'll sell a certain quantity of that good at that price. We're willing to undertake production because we've thought about it, and the budget we've laid out, we think, at least our best guess is, that we can profit from this. Right? And so the key to this, of course, is having prices. The existence of market prices, of prices that are generated by people trading goods and services for money, are key here. You need prices to form budgets. You need prices to calculate what your costs might be and to calculate what your revenues might be. Right? And so when we think about what firms do before they even produce, when they formulate budgets and think about a production plan, they need prices to do that, right? And they need prices that really do reflect the public's willingness to buy and sell those goods, their subjective values. But prices are important sort of after the fact too, when the quarter or the half year or the year is done, and we want to look backward and say, how do we do? Right? We need prices. We need to know how much did we spend on all of our inputs? How much did we spend on labor, on capital, on loans? And, of course, what were our revenues, right? Prices enable us to calculate those revenues. And so after the fact, when we want to know, did we do well? We need prices to engage in that process of calculation. And all of this that we're talking about here is what we call monetary calculation. That is the process of calculating revenues and costs and profits and losses in terms of the money prices of goods and services. And having that ability, thanks to market prices, enables all of us, but especially entrepreneurs, to again engage in these acts of calculation and comparison to know how to best use resources to meet the wants of others. What profits tell us is that entrepreneurs created value. They took a set of inputs, they made something more valuable out of it. People valued the final product more than the inputs. When you buy the iPhone X, right, you're buying it because what you're saying is, I value that iPhone more than I value the sum of the individual parts, right? What Apple paid for those parts, what it sells the iPhone for, two different things. It profits off of it. You consider the completed iPhone more valuable than the parts. Right? Same thing with that latte at Starbucks, right? You pay $4 for it. Starbucks profits off it because they've taken the raw ingredients and turned it into something you value more than the sum of the raw ingredients. They have created value. You benefit from that, right? You get the good or service that you want, the iPhone, the latte, get your hair cut, whatever it might be, right? You benefit from that, and they benefit too, right? That's our mutual benefit of exchange. And so you can think about profits, right, as a reflection of the value that firms create for other people. Right? Too often people want to talk about profits as being something that firms take from others, but it's not a matter of taking it, right? It's part of the exchange. Their profit is reflected in your subjective evaluation that you prefer the iPhone to the sum of the parts, you prefer the latte to the sum of the parts, you prefer having someone else make your clothes than making it yourself, whatever it might be, right? The profits that firms make off the things that you buy are a reflection of the value you put on having those goods and services. The economist W.H. Hutt once said, profits are proof of social service. And in the marketplace, right, that makes sense. If you profit, it's because you've provided things that people want. But notice, right, what happens with losses. Right? Losses tell us you messed up. Right? Losses tell us that you didn't create value. You actually destroyed value. When firms make losses, what it means is the thing they created was less valuable than the sum of the inputs that went into making it. Right? If Starbucks should lose money on their lattes, what it's saying is that people don't find value in that combination of ingredients, that in fact the individual ingredients were more valuable than the combination in the form of that latte. So losses tell us that we've destroyed value. Notice that both profit and losses are important because they provide us with information. They are signals. They are about knowledge, just like prices are. And they tell us what to do and what not to do. Right? The key with profits and losses isn't that firms somehow magically maximize their profits all the time. Right? Profits and losses, what's important about them is that they provide us with signals that enable us to adjust our behavior, to react and to respond when we make mistakes. They're ultimately about error correction. Right? Losses tell us we messed up, we need to change things. Profits tell us you did this right. Continue doing it unless you think something else has changed. So profit and losses have this knowledge function. They inform us about things in ways that no other process can. right? There's in the absence of profits and losses and market prices, there's no way to know whether we've created value or destroyed value. And we've seen this in countries that tried to get rid of market economies, the Soviet-style economies, right? Destroyed themselves because they undermine the role that profit and loss play. And we see this happen too in smaller places in the U.S. economy today, places where the government plays, let's say, a very big role and prevents firms from making profits, or at least sets up rules of the game in such a way that means that firms profit by doing things that don't serve consumers. Again, I can't go into great detail here, but healthcare is a good example of this, right? Healthcare is not a free market, right? The profits that healthcare firms make, or the profits that firms make on the military-industrial complex, don't reflect value necessarily given to consumers. It often reflects them having done what the government has said they need to do or wants them to do in particular kinds of ways. Technology is usually a better example where we see successful tech products where people make profits are usually because they've created value. So one key lesson here to remember is that profits aren't always a signal that you've done well. Right? Profits in a genuine market, in a market with private property, with the use of money, where government doesn't set prices or create monopolies or interfere with people's process of exchange. In those markets, profits play this role of informing us of the creation or the destruction of value, and this irreplaceable role that they play. But when we start talking about markets where those things aren't the case, right, where government has intervened and interfered, profits can mean all kinds of things. And often what profits means is that you've pleased politicians or policymakers, not that you've pleased consumers. And what we want in the marketplace, well, the reason that economists think freer markets are better is because it creates the information and incentives through prices and profits and losses to help entrepreneurs and to help producers produce those things that consumers, the public, wants, not the very narrow things that politicians or others coming from a place of privilege might want. So the key point here about profits and loss is that they play this irreplaceable role as a signal and as an incentive in helping us to know when we've made mistakes and to give us an incentive to correct those errors and create value. So that's the key social role of profits and losses. And as you look through this chapter, look at all the details about what entrepreneurs do and how we calculate this, it's important. That's the context to keep in mind. That's why we care about these questions of calculating profit and what entrepreneurs do, is because we need entrepreneurs and we need profit and loss signals to be able to know what to produce and how best to produce it.